Silver isn't T rising because people suddenly feel bullish. It's S rising because the plumbing is getting tight and the curve is starting to admit it. And the weird part is how hard some people are working to keep you focused on the wrong culprit. It's just retail stacking. It's just meme money. It's just a headline. Meanwhile, the parts of the market that don't care about vibes, spreads, deliverability, near-term urgency are flashing the kind of signal that usually shows up before the broader crowd realizes the game has changed. And here, S, the concrete payoff you are getting by the end of this video, the one hidden detail that actually explains the inventory drawdown story. The calendar trigger that can force the next move over the next week or two, the levels that matter, and the checklist that tells you whether this is a controlled retest or the kind of continuation squeeze where you done it to get the dip you think you re-owed. The easy story is retail stacking did this, but the pros are staring at deliverability, spreads, and who's being forced to source metal at the margin. Because in silver, the loudest truth is rarely the headline price. It's the structure underneath it. It's who has to roll, who has to deliver, who has to hedge, who can't find offers when liquidity thins. And if you've ever watched silver behave like it's dead, right before it suddenly turns feral, you already know the vibe. It goes quiet. Everyone gets bored. The paper market looks comfortable. Then something shifts. And once it shifts, it doesn't politely move in a straight line. It snaps, it gaps, it whips. It scares weak hands out. And that's where the real pressure starts. Right now, today, this week, this month, the price action itself is telling you something simple. Silver is trading like a market that can find enough offers at the margin. You get a push, you get a pullback, and then you get that stubborn refusal to fully mean revert. That's not a guarantee of anything. It's not a promise of infinite upside. But it is a signature you see when the bid is not purely speculative, when the bid has to do something, when buyers aren't just dreaming about a higher price, they're managing exposure, replacing metal rolling obligations, or front-running a known calendar constraint. And if you think that's dramatic, here's the pivot. The inventory drawdown story is not about total silver in vaults. That's the number everyone parrots. That's the number everyone misreads. The hidden detail is the kind of inventory and how fast deliverable supply can vanish when the incentive flips. And that's not a conspiracy. That's just market design. Let's make this clean, because silver loves to punish people who keep the mechanics fuzzy. Inside the warehousing ecosystem, there is a difference between metal that exists in a vault and metal that is actually registered and ready to be delivered against futures obligations. Think of eligible silver-like boxes in the back room, and registered silver-like boxes already labeled for checkout. Both exist, but only one is ready to leave. Eligible means it meets specs and is stored in an approved facility, but it's not committed for delivery. Registered is the portion that is specifically designated as deliverable inventory. That distinction matters because when the market gets stressed, the question isn't, is there silver on Earth? The question is, how much is available right now at this price, under these delivery rules, without someone needing to be bribed with a premium to release it? And if you've never watched a commodity market choke on that distinction, don't worry, silver will happily teach you. Here's why the total inventory number is the wrong obsession. Eligible metal can sit there for months, years, acting like it's part of supply, while functionally it's not. It's owned. It's financed, it's earmarked, it's waiting. Sometimes it's sitting there because the owner is happy earning a spread. Sometimes because it's collateral. Sometimes because the owner is explicitly not willing to convert it into deliverable form unless the economics change. And that unless is everything. Because when the front end of the curve tightens, when immediate demand for deliverable supply rises, registered stocks can draw down quickly. Metal can leave, or metal can be reclassified, or it can be withheld. And that's where people get fooled. They see a drawdown and assume it's running out, or they see eligible sitting there and assume it's plentiful. The truth is dynamic. It's incentives. It's the cost of carry. It's financing. It's willingness. It's the spread. And that's not the part that matters. The part that matters is what the curve is willing to pay you to do. Because in commodities, time has a price. If the market is relaxed, you usually get contango, future months priced higher than spot, because holding physical costs money, storage, insurance, financing, and the market compensates holders for carrying. But when the market is tight, you can get backwardation, near months priced higher than later months, because the market wants metal now. It will pay up to pull supply forward. That is the market yelling convenience yield without using the academic words. That's the market telling you immediate availability is scarce relative to demand. And if that's showing up, it means the battle is not purely in the headlines. It's in urgency. It's in delivery timing. It's in spreads. And spreads don't lie as easily as outright price, because spreads are where real hedging pressure and real sourcing needs get expressed. So watch the calendar spreads, watch the front month versus the next month. Watch how that relationship behaves when price pulls back. If silver sells off and the spreads stay tight, if the front end stays bid, that not normal speculators got bored. That's someone still needs metal soon. That's where the real pressure starts, because the outright price is a billboard. The spreads are the wiring behind the sign. And when the wiring starts heating up, you can get weird outcomes. Price that should retrace doesn't. Dips that should fill don't. Offers disappear at key levels. Volatility spikes not because of news, but because liquidity thins at the wrong time. Now, layer in the fact that futures contracts have a date stamp. Futures aren't forever. Delivery windows show up on the calendar like deadlines, and that's when paper has to prove it can behave like metal. Foire. If you only short a futures contract into delivery and you can T or 1-T roll, you're in the zone where obligations get real. And the market knows this. Participants know this. They position around it. Some roll early, some wait, some try to press spreads to their advantage. And sometimes the market squeezes the people who assume they could always roll cheaply and find liquidity whenever they wanted. Because if too many players try to do the same thing at once, roll, hedge, source, cover, the market doesn't gently accommodate. It reprices, it forces, it reveals who is weak. Here's a fast mental model. When nearby supply feels abundant, shorts are comfortable. They can roll, they can borrow, they can hedge, they can find offers. But when nearby supply tightens, the short side starts to feel friction. Rolling becomes more expensive. The spread moves against them, the paper market starts acting like a clock. And that's when registered inventory matters more than total inventory, because deliverability is what resolves that friction. If the deliverable shelf gets thinner at the same time the spread is paying for immediacy, that's the setup where small imbalances can snowball. Now let's talk about retail stacking, because I'm not going to dismiss it. And I am also not going to let it hijack the story. Retail stacking doesn't drain futures vaults one coin at a time like some cartoon vacuum cleaner, but it does matter in a different way. It changes the availability curve of real metal, and it changes behavior around hedging and sourcing. When retail demand is strong, you see it in premiums and product delays, in the out-of-stock moments that seem irrational if you only watch spot. That gap between spot and what people actually pay for physical products is information. It's not perfect information. It can be distorted by fabrication bottlenecks, by logistics, by dealer inventory choices, but it's still a symptom. It's telling you the market for small form factor deliverable silver is tight. And when that's tight, it can feed into the broader ecosystem through a few channels. Dealers hedge, refiners get booked, wholesalers get drained, and the marginal unit gets priced differently. But the next detail is what flips the whole setup. Retail demand becomes truly relevant to the bigger structure when it collides with institutional flows and industrial procurement. Because silver is not just a monetary metal, it's not just a fear trade, it's also a working metal. And when industrial demand is steady or rising, it removes supply that can't easily be substituted. Silver is used in electronics, in energy infrastructure, and in places where you don't get to say, let's just swap to something else this quarter. That's not how manufacturing works. Lead times exist, qualification exists, engineering constraints exist. And when industrial procurement meets a market where the front end is tight, the market stops being purely speculative. It becomes functional, it becomes a supply chain story. And supply chain stories don't end politely. Now add the institutional layer. Big pools of capital don't just like the story. When they flow into silver exposure, ETFs, trusts, ETPs, whatever vehicle you track, they change the demand profile. Sometimes that translates directly into physical sourcing and custody. Sometimes it translates into derivatives exposure that then forces hedging. Either way, it changes behavior. It reroutes flow. It can tighten certain locations while loosening others. It can pull metal out of one ecosystem and park it in another. And here's the key. These flows don't arrive smoothly. They come in bursts. They chase momentum. They cluster around calendar events, month end, quarter end, options expiry, rebalancing windows, because that's when mandates get executed and risk is managed. And that's why the calendar is not a side note, it's a catalyst. Because if one level breaks, the math changes. The moment silver moves into a zone where options positioning is thick, where there's a wall of open interest on calls or puts, the hedging flows can become reflexive. Here, it's the simple explainer without the jargon soup. Options dealers often hedge their exposure by buying or selling the underlying as price moves. If price rises and a bunch of calls become more sensitive and more in the money, dealers may need to buy more silver exposure to stay hedged. That buying can push price up more, which increases the need to hedge, which can push price up again. That's the reflexive loop. That's the gamma effect. It can create those, why is it moving like this? Those days where price feels like it's being pulled by a magnet. But it can also reverse fast if momentum stalls or if flows shift. That's why you respect it, but you don't worship it. Now let's stitch the story together like a trader, not like a commentator. You've got potential tightness and deliverable categories. You've got spreads that can reflect urgency. You've got a retail market that may be paying up for immediate physical products. You've got industrial demand that doesn't care about your chart lines. You've got institutional flows that cluster around calendar triggers. And you've got an options market that can turn a level into a launch pad. That's a proof stack. That's multiple layers. And none of them require a cartoon villain. They just require incentives and constraints. And that gives why this move can be real, even when price whips you around violently. Let's talk about the drawdown itself in the most practical way possible. When people say inventory is drawing down, you need to ask two questions immediately. One, which category is drawing down? Deliverable registered supply or broader stored eligible supply? Two, is this a true outflow, metal leaving, or a reclassification, metal changing status? Because the implications differ. If registered is drawing down because metal is being delivered out, that's a direct signal that near-term obligations are being met with physical movement. If registered is drawing down because holders are deregistering, moving it back to eligible, it can mean they don't want to make it available at current economics. That can actually be bullish for tightness because it reduces deliverable availability without reducing total metal. It's the owner saying, not at this price. But it can also be a neutral administrative move depending on context. You don't guess. You watch the trend. You watch how spreads behave alongside it. You watch whether price dips are bought. You watch whether the market is paying up for immediacy. That's where the signal lives. And that's not the part that matters either. The part that matters is what the market forces participants to do next. If deliverable availability feels tight, shorts have to decide whether to roll early, pay the spread, or risk getting squeezed in a low liquidity window. If spreads are tight or backwardated, rolling can be painful. If rolling is painful, some shorts cover outright. If shorts cover, price can move fast. If price moves fast, options hedging can add fuel. If options hedging adds fuel, momentum funds notice. If momentum funds notice, you can get a cascade. That's reflexivity, that's not conspiracy, that's structure. Now zoom out to the macro layer, because silver doesn't move in a vacuum. Silver is sensitive to the real rate regime and to currency stress. When real yields rise and the dollar strengthens, precious metals often face headwinds. When real yields fall or inflation expectations rise, precious metals can catch a bid. But silver adds an extra twist. It can perform even when gold is steady if industrial demand is strong and supply is constrained. It's the metal that can surprise both camps. The "it's purely monetary" camp gets caught when industry keeps buying. The "it's purely industrial" camp gets caught when the macro bid shows up. That dual engine is why silver's volatility is legendary. It's why silver can look dead for months, then explode in weeks. And it's why your job isn't to predict headlines. It's to understand the mechanism and track the stress points. And here, as a stress point people ignore, supply is not as elastic as the narrative makes it sound. Silver production is often tied to other metals because silver is frequently a byproduct. That means you don't just turn on silver supply because silver price went up. If the primary metal economics don't support increased production, silver supply doesn't magically surge. Recycling helps, but recycling has its own constraints and lag. Refining capacity is not infinite. Logistics has friction. And when demand rises faster than the system can respond, the front end tightens first. Not always with a smooth price increase. Sometimes with spreads, sometimes with premiums, sometimes with delays, sometimes with a sudden scramble for deliverability. So when you hear inventory drawdown, think of it like a pressure gauge, not a countdown clock. It's telling you stress is building in the immediate availability channel. And stress doesn't resolve with a calm press release. It resolves by forcing behavior. It forces someone to pay up. It forces someone to release metal. It forces someone to roll. It forces someone to cover. It forces someone to hedge. And once the forcing starts, price discovery changes. The market stops being liquid. Liquidity thins. Slippage appears. The tape gets jumpy, and that's when the headlines become weapons. Because volatility will try to rob you. That's not poetic. That's literally what markets do. They use emotional leverage. They spike to trigger FOMO. They dump to trigger panic. They hover to exhaust you. And silver is especially good at this because it attracts strong opinions. People treat it like a moral crusade instead of a market. And that makes them easy to manipulate, by their own emotions first, and by opportunistic flows second. So here's your psychology shield. You predefine what matters. You decide what is trend signal and what is noise. You decide what invalidates your thesis. You size so that a violent pullback doesn't force you to sell at the worst time. You expect the whip, because even if the thesis is right, price can still whip around violently. That is the tax you pay to participate in a market that can move faster than your nervous system. Now I'm going to give you the near-term roadmap, but we do it with a two-scenario lens because that's how you keep credibility and keep your head. Scenario 1 is the controlled pullback and retest. Price runs, it cools, it pulls back into a prior breakout zone or a key support area, and it holds. In that scenario, the market is digesting gains. It's letting late longs get shaken. It's letting spreads and positioning reset. You'll often see dip buyers show up with urgency. You'll often see the sell-off lose momentum quickly. You'll often see that the front end of the curve doesn't fully relax. Spreads stay relatively tight. That's your structural confirmation. The market is not just taking profits. It's maintaining tightness underneath. Scenario 2 is the continuation, squeeze, and gap risk. That's the one where you don't get the dip you think you deserve. Price pauses, then pushes again, often around a calendar catalyst. Options expiry, month end, a delivery window, or a macro impulse like a sharp move in yields or the dollar. In that scenario, what matters is speed. If price accelerates through a prior resistance zone, the hedging flows can turn on. Shorts can get forced, liquidity can thin at the worst time, and you can get gaps, moves that happen faster than you can react. That's why you don't chase blindly. That's why you don't go all in on a single candle. That's why you respect the levels and the invalidation. Now, I'm not going to pretend I can see your chart on the screen, and I'm not going to invent exact numbers like some carnival barker, but the level framework is simple and universal. You identify the most recent breakout zone, the area where price accelerated from. That zone becomes your first major support on a retest. You identify the most recent swing low that preceded the impulse. If price breaks below that with conviction, the near-term momentum structure is damaged. You identify the overhead supply zone, the area where sellers previously defended. If price reclaims that and holds, the path of least resistance shifts upward. And you watch how price behaves at those areas. Does it bounce on high urgency? Does it chop and grind? Does it slice through? Because behavior at levels tells you more than the level itself. But that's not the part that matters. The part that matters is what confirms the thesis in the next week or two. And you can build a clean checklist that doesn't require belief. First, does the term structure stay firm? Do near months stay relatively bid versus later months? Second, do deliverable categories remain tight or continue to show stress? Even if totals look large, does the deliverable shelf behave like it's being rationed? Third, do dips get absorbed quickly, especially on higher volume or in thin liquidity windows? Fourth, do physical signals, premiums, availability, lead times, stay elevated or tighten further? Fifth, do institutional flows or positioning indicators suggest continued demand rather than a one-day wonder? Sixth, do cross-market cues like gold stability, dollar moves, real yields support the bid, or are they fighting it? And this is where the mainstream misses the plot. They were going to show you the price chart and give you a story that fits the day. Silver fell because rates. Silver rose because fear. Those can be true on the surface, but the deeper truth is whether the market is tight in the right place. The place that matters is immediacy and deliverability. If the market keeps paying for now, if the deliverable shelf is stressed, if hedgers can't find offers without moving the market, then silver can remain explosive even as narratives flip daily. And that's where the real pressure starts. Now let's talk about counterpoints, because if you can't argue the other side, you're not doing analysis, you're doing fandom. The biggest counterpoint is that inventories can change classification quickly and make stress look worse or better overnight. A big re-registration can show up and calm the market temporarily. Another counterpoint is that if macro conditions flip hard, real yields spike, the dollar surges, precious metals can get slapped even if the physical story is tight. Another counterpoint is that a big speculative run can front-run itself. Everyone piles in, positioning gets crowded, and then you get a brutal shakeout that feels like the thesis died, even though it didn't die in count T. Another counterpoint is that industrial demand can slow if the economy contracts sharply. And another counterpoint is that policymakers can influence liquidity and risk appetite in ways that swamp microstructure in the short term. So you treat this like a probability game, not a prophecy. You don't need the market to behave politely. You need your plan to survive its worst behavior. You need to know what would weaken the thesis. For example, if the curve relaxes meaningfully, nearby spreads loosen, backwardation fades, the market stops paying for immediacy, that suggests tightness is easing. If deliverable categories rebuild while price struggles to hold key levels, that suggests stress is resolving. If dips start getting sold aggressively and recoveries look weak, that suggests the bid is fading. If options-driven spikes immediately revert and can't reclaim the breakout zone, that suggests the move was more mechanical than structural. Those are the tells, not the headlines. Now here's the why now calendar trigger that matters more than people admit. Month end and quarter end are not just calendar squares. They're when funds rebalance, when mandates get enforced, when risk is measured and reduced, when rolling happens, when hedges get reset. Liquidity often thins around these windows because large players step back or because flows become one-sided. Thin liquidity turns normal orders into price events. Add options expiry into that mix, where big strikes can act like gravity wells, and you get the conditions for outsized moves. And then add delivery windows, where the futures contract's paper promise has to translate into physical logistics. That combination is why the next week or two can be decisive, not because of a single headline, because the calendar forces action. And the market doesn't care if you're ready. That's why you build your checklist now. You decide what you're watching every day, not what you feel every day. You monitor spreads, you monitor deliverability signals, you monitor behavior at levels, you monitor how price reacts to bad news. Because if silver shrugs off bearish headlines, that's information. If it drops on bearish headlines but immediately gets bid back, that's information. If it drops and stays heavy, that's information. The response matters more than the stimulus, always. Now let's make this feel real and not abstract. Picture a dealer network where retail demand is pulling product faster than fabrication and distribution can refill. Premiums rise, inventory on shelves drains, dealers hedge their exposure in futures to manage price risk. Meanwhile, an institutional flow arrives, maybe a burst of allocation to metals exposure, maybe a rotation out of something else into real assets. That flow either demands physical or demands hedging. At the same time, an industrial buyer needs metal for production cycles. They don't buy 1 ounce, they buy size. They may lock in forward needs. They may be price insensitive over a short window because production matters more than saving a few cents. Then, the futures market enters a delivery window. Some shorts expected to roll easily, but spreads have tightened. Rolling is expensive. Liquidity is thinner because it's month end. Price pushes into an option zone. Dealers hedge. The tape accelerates. Suddenly, you've got forced buying in a market with limited offers. And the move doesn't look rational if you're watching a headline feed. It looks completely rational if you're watching constraints and incentives. This is why people get whipsawed. They're watching the wrong screen. They're watching price as if it's a moral verdict. They're watching narratives as if they're causal. In reality, the causal chain is often mechanical. Spreads, delivery, hedging, flows. And when those mechanics align, the market can move like it's possessed. Now, if you're the skeptic, good. Skeptics survive. Skeptics ask, what would I need to see to change my mind? Here's what you watch if you want evidence. You watch whether backwardation appears or intensifies in the front end, or whether contango reasserts itself. You watch whether spreads scream while outright price is quiet, because that's often the early warning. You watch whether reported inventory categories change in ways that reflect tightening deliverability. You watch whether retail premiums stay elevated relative to spot. You watch whether dips are bought faster than before. You watch whether silver starts outperforming in a way that can be explained solely by gold or macro. Those are symptoms. And when multiple symptoms align, you've got a stronger case than any single chart line. And now, because this is where viewers usually get emotionally hijacked, let us talk about how volatility will be used against you. The market will give you a huge green candle and make you feel stupid for not buying earlier. Then it will dump hard and make you feel stupid for buying. Then it will grind sideways and make you feel bored and impatient. That cycle is designed, by structure, not by an evil committee, to extract mistakes. The antidote is boring, and that's why it works. You predefine your time horizon. You separate trend signal from noise. You don't confuse a one-day spike with a structural shift, and you don't confuse a one-day dump with a broken thesis. You use levels as decision points, not as emotional triggers. You size so you can hold through the whip, and you keep a two-scenario lens so you're not surprised by normal market behavior. Here's a simple way to apply that lens without turning your brain into a spreadsheet. If the market is in a controlled retest, you expect pullbacks to find buyers around prior breakout zones. You expect to reclaim and hold. You expect spreads to remain relatively supported. If the market is in a continuation squeeze, you expect shallow pullbacks and fast rebounds. You expect levels to break and not look back. You expect gaps and thin liquidity moves around catalysts. In both cases, you respect the possibility of violent reversals. In both cases, you avoid the sin that kills most retail investors, trying to trade every candle like you a RIA machine. Now, let's be explicit about what invalidates the bullish structural story in the near term. If you see the front end of the curve relax meaningfully, spreads widen the wrong way, backwardation fades, and you see deliverable signals rebuild while price can't hold key support, that suggests the tightness narrative is easing. If you see heavy selling that isn't T being absorbed, meaning bounces are weak and sellers regain control quickly, that is a warning. If you see macro conditions turn sharply hostile and silver can't stabilize, that's a warning. If you see a blow-off move followed by an inability to reclaim the breakout zone, that's a warning. Those are the conditions where you stop telling yourself stories and start listening to the market. But if the opposite happens, If spreads stay tight, if deliverability remains stressed, if dips are shallow and bought, if premiums stay elevated, if price holds the breakout zone, then the market is telling you the same thing again and again. Near-term supply is not loose. And when near-term supply is not loose, price discovery shifts upward more easily than most people expect. Now, I want to address the institutional skeptic crowd directly, because I know you're here. You don't need to believe in perfect, clean markets to understand why silver behaves like this. Incentives create patterns. Market structure creates pressure points. Participants hedge and manage risk in predictable ways. Banks and funds don't wake up and decide to be villains. They wake up and decide to manage exposure. They respond to constraints. They respond to margin. They respond to VAR. They respond to liquidity. When volatility rises, risk managers force behavior. When risk managers force behavior, it can create feedback loops that look like manipulation to people who don't understand the mechanics. Sometimes there are distortions. Sometimes there are questionable practices. But you don't have to litigate that to trade the market in front of you. You just have to understand what pressures participants to act. And that's where the real pressure starts. Margin and funding. When price moves fast, leveraged players have to post more margin. When margin demands rise, some players reduce exposure. That can cause sharp sell-offs even in a bullish environment. Then, if the underlying tightness remains, buyers step in and the market rebounds, leaving the emotionally reactive crowd exhausted. That's why silver's volatility can be a feature, not a bug, for those who understand it. It's also why it can be a trap for those who don't. So what comes next? Over the next week or two, you're watching for one of two confirmations. Confirmation A is the controlled pullback. Silver dips into the breakout area, holds, and then grinds back up with spreads staying firm. Confirmation B is the continuation squeeze. Silver holds high, consolidates shallowly, then pushes through a key resistance area and accelerates as hedging flows turn on. In either case, the key is behavior at levels and behavior in the curve. If the curve stays urgent while price consolidates, that's constructive. If the curve relaxes while price looks heavy, that's caution. And here is the part most people miss. Sometimes the secret isn't a single metric. It's the relationship between metrics. Price can lie for a day. Spreads can lie briefly. Inventory categories can be noisy. But when price refuses to mean revert and the front end remains tight and physical signals remain elevated, the combined message is harder to ignore. That's when the market can't unsee it. That's when you stop treating rallies as flukes and start treating dips as events. Opportunities for someone, danger for someone else. Now, let's talk about what to watch next in the most grounded, non-hype way possible. First, track the front month versus next month spread behavior during pullbacks. If pullbacks don't loosen the spread, the market still wants metal now. Second, watch for any signs that deliverable categories remain constrained or get constrained again after any brief rebuild. Third, watch retail premiums and availability as a temperature check, not as your only signal, but as a symptom. Fourth, watch macro. If real yields drop or the dollar softens, that can align with the move and add fuel. If they spike, that can create headwinds and violent shakeouts. Fifth, watch option zones. If silver hovers near a big strike area going into expiry, expect weirdness, pinning, magnet moves, sudden accelerations. Sixth, watch the tape at key levels. Does it reject quickly, or does it accept and build value? If you do that, you stop being the person who gets whiplashed by every headline. You become the person who sees the setup early and stays calm when the market tries to scare you out of it. And that's the identity shift that actually matters. Not being right, being stable, being systematic. Being the investor who watches the right screen. And here's your subtle CTA, because we're not begging here. We're rebuilding a tribe of people who refuse to be emotionally farmed. If you're the kind of person who wants the mechanism, not the meme, if you want the checklist, not the cope, stick around and keep your eyes on the plumbing with us. The crowd will argue narratives. We'll watch what forces participants to act. Because in silver, the story always sounds obvious after the move. The edge is seeing the constraint before it becomes a headline. One last thing before we close. Don't confuse intensity with certainty. This market can rip your face off in both directions. You can be structurally right and still get a brutal drawdown if you resized wrong or if you panic at the wrong moment. So keep your time horizon honest, keep your position size humane, keep your invalidation clear, and keep your attention on the one hidden detail that frames the entire inventory drawdown debate. Not how much silver exists in the building, but how much is actually deliverable at the margin when the calendar forces the paper market to behave like the physical market. Because when that deliverable shelf tightens, the curve speaks first. And when the curve speaks first, price eventually has to listen.